people think that life insurance, the problem that they have with it is that they quit. 7 out of 8 people who buy a life insurance, up to 7 out of 8, quit the policy. They lose their money.
They pay, then they stop paying.
Yeah, people get mad. They get upset. They get mad. Oh, the policy didn't perform. They bought it when interest rates were high, and they bought some interest-sensitive policy, and now interest rates are low. It does. They're mad. What people have to understand is, you in the 7 out of 8, up to 7 who quit, out of 8 who buy, it's the one that makes the money that goes the difference. You want to be the one, not the 7.
Just to hang on.
Hey, hang on. So buy a life insurance. The way to not lose money in life insurance and to profit and to put it in your portfolio as an asset, it's equivalent, I like to say, related to it's like buying a building. So you buy a policy that has a 300, 500,000, a million, 5 million, 10 million. Wait a second. You have to understand. A company contracted to pay you that money tax-free at some point in the future.
Yeah, that's a good deal.
So I say to people, oh, Dave, I can't do $3 million. I can only do $250,000. I said, okay, so hold out your hand. I'm going to put $250,000 of tax-free cash in there. How does it feel? Pretty good? Would you like to have it? I said, so don't just think it's for the big people.
Yeah.
I said, buy it, whether it costs. So dramatize my point is, you want to go the distance. The way you make money in life insurance is to buy a policy with the minimum premium.
Yeah.
It's like buying an investment. But it's not an investment. It's an insurance policy. It's like you want to put in the least amount of money, get the biggest death benefit you can, and then you want to be there down the road when you're 60, 70, 80, because your probability of death is there. And then the conversation you and I were having off the air was, wait a second. At that point in time, wait a second, I get to 75 years old, I need some money. I'm tired of paying the premiums.
And I don't need the life insurance anymore.
Yeah, what are my options?
My kids are grown, they've got their own assets now, I don't need to protect my family like I used to, so on and so forth.
Yeah, or I want long-term care insurance instead of life insurance, but I can't get my money out. Okay, so your options are 2. You can go to the life insurance company and quit. But quitters do what? Do they win or lose?
They lose because and they put all this money in and they haven't taken it.
They lose. They have a bad taste in the mouth because they didn't understand the math or no one explained it to them like we do, you and I on the show and in the book. So what happens is your second way to get out is, wait a second, I shop it.
What do you mean you shop it? You sell
it? People come to us with policies and I say, wait a second, don't quit. A woman came to us with a $10 million policy as a term policy. She was in her late 70s. I got to remember this right. But she said, my son told me to come see you. This is some years ago. And she said, I'm going to quit the policy. I don't want to make the premiums in. I'm healthy. I said, okay, so why don't you just let us shop it and see if we can get more than 0?
Okay, so in other words, there's a market for this?
There's a market for this. Credit Suisse, pension funds, hedge funds, retirement funds.
So they're gonna insure your life for you.
They figured out real quickly is, wait a second.
If we buy this at a discount.
Grandma's 80 years old. Her life expectancy is 6 years. The premiums are only 5% of the death benefit.
So they figure if they continue paying the premium, then you make them the beneficiary.
You make them the owner and the beneficiary. You're sitting there. So in this case,
so they pay you in advance for.
In the example of my $10 million policy, which is, it doesn't matter whether you have a $200,000 policy. We sold it for $2 million.
She got $2 million cash.
$2 million cash. So that's the beauty of it. Now here's the rules. The life insurance companies have set up this opportunity in insurance contracts, and it's been on for 100 years or more.
Yeah.
So it's a beautiful environment, and there's rules and regulations, and you need to abide by them. You don't buy a policy with the intent to sell it. Buy a policy because the biggest winner isn't the person who sells a policy when they're 82 years old. It's the person who goes the distance. If you're 78 years old and you're tired of your life insurance, don't want to make the premium, then give it to your kids.
Oh, there you go. Okay, great.
Give it to the charity. It's the biggest asset.
So if just as an exclamation point here, if your kids purchase the policy, or if you give it to your kids, can they in turn sell the policy down the road if they don't need it?
They have the option to do it, whatever.
So basically what you're talking about is A+ rated banks buy and finance your life insurance premiums is really what's happening here.
Yeah, so what happens so I have a client right now, dad is 78, life expectancy is probably 6 years, his health isn't good.
Yeah.
So we got him approved. We negotiated his health rating, so that's a very opportunistic health rating, which means his premiums are low. Well, we go to the bank and finance the premium. The premiums are high, but it's a big policy. So if the premiums are 100 or 200,000 a year, if you borrow let's say 100,000 a year at 3%, and it only costs you 3,000 a year. So that at the end of 6 years, let's say dad passes away. We hope he lives forever, but at the end of 6 years, he passes away. You owe the bank $600,000. So let's say the policy's $2 million. You bought a $2 million policy. Dad passes away. You owe the bank $600,000. So now your profit's $1.4 million. You paid out of pocket $3,000 a year for 6 years to finance the policy.
Okay. Last of all, talk about restructuring your policy for future sale. Is that what that is?
Yeah, restructuring is people own outdated policies that are, you know, they're paying premiums all their life, and they get to a point and they go, wait a minute, I don't want to pay these premiums. In the policy, I own a small policy. I'd rather own a bigger policy. So let's say they own $1 million policy, and use an example. Let's say they sold it for $300,000. Well, and they go buy a $2 million policy with the cash proceeds, or they buy a smaller policy and put $100,000 in their pocket. You have all the options you can do. You can restructure that policy to buy a bigger policy, or you could take the cash and buy a smaller policy and put the cash in your pocket.
So insurance, I guess my question is why aren't insurance companies doing a better job of advertising this type of stuff? Because I think more people would purchase it. Why is it up to you as the agent, let's say, of the face of the insurance company? Why aren't they doing a better job, mass media? They spend so much money in advertising. And it's all about protect your family, protect your family, protect your family.
I absolutely think they're missing it. I absolutely believe they've mispositioned. If you talk about marketing, they've mispositioned the asset. They're as an expense instead of an asset. In the book, what we do is we position it as an asset. They don't want you to buy it to sell. So our conversation on selling your policy, they don't want that. It's not the way to do business anyway. But that is one of your options. But all the other positive things
I'm talking about the tax-free side, and the investment grade side. I'm not even talking about the selling side of it, because they're playing on people's emotions about protect your family, and it's usually a one-sentence thing in a magazine, and people, oh yeah, I better get life insurance. No, they don't understand why you need life insurance. It's just, it's so insane. The name of the book, The Secret Asset: Making Millions with Investment Grade Life Insurance. David D'Arcangelo, my co-host here, and he's the author. You can go to thesecretasset.com. You can download a free copy of the book there.